move into self-managed super funds. Liam Shorte from SONAS Wealth joining me now. Good to see you, Liam. So we're looking at the pension start limit. This is going to increase in July.
Yeah, so the December CPI figures came out, and that's how that limit is decided, and ticked over the magic number to be able to move the transfer balance cap, it's called, from 1.9 million to $2 million. So that just means that anybody retiring now after age 60 can move up to $2 million across into pension phase to start their pension for retirement. So it's just one of those strategies people need to think about. If they've retired now, they may want to wait until 1st of July to actually move it into pension phase. But that means that it'll be 6 more months of their money sitting in accumulation where it pays 15% tax. In pension phase, it's tax exempt, and you get a refund of all those beautiful franking credits, and the income that comes out is not reportable on your tax return. So it's a nice even number going forward, $2 million starting pensions.
All right, well, let's talk about the election campaign and, of course, what we're seeing in terms of Division 296 tax. Labor really trying to potentially push this through.
Yeah, we're not absolutely sure, but on the last day of the last parliamentary sitting, they slated these laws to be put back up in front of the Parliament again on the first sitting of February. So unless they change their minds before early next week, they're going to reintroduce the laws to Parliament again and try and push it through. Now today, Stephen Jones has just announced that he's not going to rerun for election. So I don't know whether he sees this as his last hurrah and he will push it, or whether he thinks, I don't want to go out on a bummer of losing, so maybe he'll just drop it and let it flow. But it is really bad legislation. It's badly written. It involves taxing unrealised capital gains and no indexation of the limit. So we just think, we're not saying it's, you can't tax pensions. We're just saying you need to actually discuss it with the industry, discuss it with the accountants, and make sure that it's done properly and it's not creating an unfair situation for investors.
When it comes to looking as well at the SMSF picture, I mean, it's interesting, Macquarie, who run some of these accounts, they're not cashing cheques. What does that mean for people that still like a cheque?
Yeah, so a lot of the banks are going down this route, and I think by 2028 they'll all stop cheques. But Macquarie, on the 1st of November last year, on their cash management accounts, they stopped accepting cheques and they stopped their members actually writing cheques. So this doesn't seem to have got out to a lot of the fund managers. So, for example, there's a current takeover of HPI by Charter Hall, and 2 of my clients this week have just received big cheques for the takeover payment, and they've got no way of cashing it into their Macquarie cash management account for their SMSF. So what I'm saying to people is be really careful now, because the rules, you've got to be careful about trying to cash those checks into your personal account, even if you're going to move it across to the SMSF straight away. Many banks won't let you cash it if it's in the name of a fund instead of your own personal names. So I would say to people, if you receive a check like this, you need to talk to your advisor and your accountant first before you do anything. One of the solutions may be, if your accountant has a trust account, they may be able to bank account the check into there, clear it, and then move the funds to the self-managed super fund. That would be a far more sensible way to do it than having to run the gauntlet of putting that money to a personal account and then transferring it to the SMSF, where it may be considered as early release of super. So you don't want to take a chance that your auditor is going to put that in as a contravention report.
Yeah.
So
just quickly, Liam, because we are almost out of time, but I want to understand a little bit more about the scrutinisation of new SMSF applications as well this year.
Yeah, so for the last couple of years, the ATO has been checking a number of the new applications for setting up an SMSF. So that's when you set up the SMSF and you put through the request to the ATO to regulate it. They have been checking about 20 to 27% of those applications based on people's own personal records of doing their tax returns or their business tax returns, and their own history of contributions into super. So that flags it for them, and they look at about 20 to 27 of them. The ATO is going to increase that scrutiny this year and continue it. And I believe it's a good thing, because what they're trying to do is weed out the people that are either being scammed or they've been pushed into an SMSF by somebody who's trying to sell them a property or trying to sell them crypto. So it's a good thing, and I just hope the ATO have got the people and the time to continue that service, because we want to protect the SMSF sector, and we don't want people taken advantage of.